There is a number, a small, quiet number, a percentage, and right now it is doing more damage to the global economy than any war, any election, any crisis headline you have seen this year. Most people don't know its name, but it knows theirs. It knows your mortgage rate. It knows what your government pays to stay solvent. It knows whether the company you work for survives its next debt cycle. It knows the real price of everything you thought you could afford. The number is the interest rate. And in February 2026, it just made something inevitable. Let me explain what that means and why almost no one is saying it out loud. The modern financial world runs on borrowed money. Not some of it, all of it. Governments borrow to function. Corporations borrow to grow. Households borrow to buy homes, cars, educations, lives. The entire architecture of the economy you live inside is built on one assumption, that the cost of borrowing stays manageable. For 30 years, that assumption held. From the early 1990s through 2021, interest rates across the developed world followed one consistent direction, down. Cheap money became the operating system of modern capitalism. It inflated asset prices. It powered tech booms. IT allowed governments to carry debts that would have been impossible a generation earlier. It made the rich richer and gave everyone else the illusion of access. Then 2022 arrived, and the bill came due. Inflation exploded, driven by pandemic spending, supply chain breakdowns, and years of excess liquidity flooding the system. Central banks, led by the Federal Reserve, responded with the fastest rate hiking cycle in 40 years. In 18 months, the benchmark rate went from near zero to over 5%. That is not a policy adjustment. That is a detonation in slow motion. And now, in early 2026, the debris is still falling. Here's the mechanism. When rates go up, the cost of every debt goes up with it. A homeowner who locked in a mortgage at 2% now faces renewal at 6 or 7. Their monthly payment doesn't nudge upward, it doubles. For millions of families across the United States, the UK, Canada, and Europe, this isn't macroeconomics. It is a crisis at the kitchen table, happening right now, this month, this quarter. Scale that across corporations. Companies spent the cheap money decade borrowing aggressively, buying back stock, paying dividends, expanding without restraint. That debt is now rolling over at 5 times the previous cost. The companies that look profitable on paper are, in many cases, one refinancing cycle from bleeding out, quietly, without a single dramatic headline. Scale it again to governments. The United States carries over $35 trillion in national debt as of early 2026. When rates were near zero, servicing that debt was a background cost. Today, interest payments have surpassed the entire U.S. defense budget. That structural imbalance doesn't resolve itself. It compounds, quietly, relentlessly, until something gives. But here is the part that should genuinely concern you. Central banks are trapped. If they keep rates high, they risk snapping the economy, crushing housing, triggering a wave of corporate defaults, pushing over-leveraged governments toward a debt crisis. The signs are already visible. Real estate markets freezing, consumer spending contracting, layoffs spreading through sectors that boomed in the low-rate era. If they cut rates too fast, inflation returns. The 2021 episode left permanent scars on central bank credibility. If they ease now and inflation reignites, they lose the only tool that still functions, trust. And a central bank without credibility is not a central bank. It is a liability. So they hesitate, and every week they hesitate, the pressure builds somewhere in the system. There are 3 ways this resolves. None of them are clean. The first is the soft landing that isn't. Rates come down through 2026. Markets celebrate, everyone exhales. But inflation, never fully defeated, starts climbing again. Rates have to reverse upward, except now the economy is already weakened. What looked like a rescue becomes a trap with a longer fuse. The second is the slow credit crunch. As corporate and consumer debt hits its refinancing wall, defaults begin to cluster. Not the cinematic collapse of 2008, but a grinding, multi-year erosion. Credit tightens. Lending dries up. Companies stop hiring. Banks grow cautious. The economy doesn't crash in one moment. It deflates painfully for years. This is the scenario that is hardest to see coming and hardest to escape once it arrives. The third is the black swan. One shock. A geopolitical event, a major bank failure, a sovereign debt crisis in a country most people couldn't find on a map, becomes the spark in a system soaked in accelerant. In a high-rate, high-leverage environment, a crack doesn't stay local. It travels across the global financial system in hours, and the system right now has far less buffer than it did 5 years ago. Any of these is possible. All of them are more likely than at any point in the past 15 years. Now let's make this personal, because this is not a story about central bankers. It is a story about your choices, made in the next 12 months that will echo through the next decade. If you have a mortgage resetting in the next 2 years, get your numbers, not roughly, exactly. Model what your payment looks like at 6%, at 7%, at 8%. Then decide what that means for your budget, your employment, your other financial obligations. Denial is the most expensive response available to you. If you are carrying in consumer debt, credit cards, auto loans, lines of credit, understand this. In a high-rate environment, debt compounds faster than your intuition tells you. It is not a slow problem. It is an accelerating one. The only intelligent response is to treat it as an emergency and move accordingly. If you invest, recalibrate. The decade of buying everything and watching it rise was a product of free money. That era is over. Companies with real cash flows and low debt load will outperform. Companies that grew on leverage are exposed. This is not a call to panic. It is a call to be intentional rather than passive. If you work in a rate-sensitive industry, real estate, construction, finance, retail, be honest with yourself about the environment ahead. The companies that survive the next 2 years will be the ones that made uncomfortable decisions early. The ones that waited for certainty are often the ones that didn't make it. And if you are young, building from the beginning, feeling like the math has never worked in your favor, I want to say something directly. The economy forming around you is structurally different from the one your parents navigated. The era of cheap money made certain paths easy. Those paths are narrowing. But the people who understand why that is happening, who build literacy around these forces instead of avoiding them, will have options that others won't. Knowledge in a crisis is not comfort. It is leverage. Every major financial crisis in modern history was, in hindsight, both predictable and predicted. There were always signals, in credit markets, in corporate earnings, in consumer stress, in the math that didn't quite add up. The people who saw clearly before the event didn't avoid all pain, but they had options. They had time. They made decisions from clarity rather than from panic. You are paying attention right now. That is not a small thing. We are standing at the end of one financial era and the beginning of another. The 30-year experiment in cheap money is over. The transition between what was built on that money and what must now function without it, that transition is where we are. That is what these interest rate decisions represent, not a policy tweak. A structural shift, a new operating environment that rewards fundamentals, punishes leverage, and offers no bailouts for the unprepared. The timer is running. The fuse is lit. The question is not whether this resolves quietly or loudly. The question is which side of this moment you're standing on when it does. Do the math. Get clear? Move deliberately. By the time everyone else agrees it's a crisis, you want to already be through the door.